So thanks very much to the Insurance Supervision Agency of Macedonia for inviting me and organizing this event. It's a very well organized thing. Still a lot of people attending at this late hour, for which I congratulate you. So I hope I can make this as interesting as possible, hopefully. Fingers crossed. So I thought I would not attack this problem from the actuarial perspective. After all, I'm just a mathematician, not an actuary. But I would rather speak about the regulator's approach, the insurance supervisor's approach to dealing with catastrophic risks. And actually, if we look at them from our perspective, from the perspective of a supervisory agency, one of the biggest risks that we face, catastrophic risk even, is if an insurer fails. But unfortunately, that's not something that we can ever completely avoid. So we can only, if you look at this top bubble, we can only guarantee the solvency of insurers present in our market with a certain level of certainty at a certain confidence interval in more technical terms. And there are a lot of things that can get in the way. There can be economic scenarios that go in the wrong direction. There can be natural disasters, man-made disasters. So that can all interfere. And this is also one of the reasons why we as supervisors devote so much time to insurer solvency. So much time, so much energy, so many models. That's why we focus on your financial strength. And the actuaries have a big role to play there when you value technical provisions, when you perform different types of risk management activities. And this is everything that we also look at in our supervisory procedures. And that's why we're so interested in capital of insurers. As you know, we have two basic approaches of looking at insurer capital and insurer capital requirements. In this region, you are probably most familiar with the index-based method. That's basically what we would refer to as Solvency I. And this means that you take the balance sheet of an insurer and then you apply some factors on that, and out comes a capital requirement. If you operate under Solvency II, this is another type of method, which we call a risk-based capital method, and there you would try to assess the risks that are hidden in this balance sheet and hidden in the business model of an insurer to provide the insurer with enough capital to survive events up to a certain level of confidence. And in a more recent development, we've also allowed for internal models to appear in the market. So you can have insurers, usually it's the bigger ones, that develop their own models and then ask us, regulators, for approval to use them for these purposes. And as supervisors, we don't just look at your capital requirement per se, especially under Solvency II, honestly. We look at various levels of capital adequacy. These may be quantitative, may be qualitative, maybe a mixture of both. And when we see yellow flags or red flags popping up in your risk exposures, we would gradually increase intensity of our supervisory measures to prevent a catastrophic event for us, which is basically that an insurer has to be, let's say, taken out of the market. And it looks like this. So if you sense us asking more and more questions, asking for more and more data, and being more and more intrusive, this usually means that you have broken one of those levels, and we're getting more and more interested in you. So what we're trying to do is we are trying to have these levels in place so that we can see as soon as possible if there is a chance that something will go wrong in a specific company or maybe in a specific part of the sector. This might be on a specific product, might be on a specific asset, specific type of technical provisions, whatever. Doesn't matter. I mean, depends really on the supervisory approach as such. But that's what these things do in practice. So if you see us asking a lot of questions, just know that there's something that looks, let's say, fishy to us. And we would like to know more, we would like to understand more, and we would like to react appropriately. That's what this is all about. So this is from our perspective. From the perspective of an insurer, you also have catastrophic risks that you have to take into account. And these can be taken into account through a capital requirement. This is what happens in Solvency II, for example. So if you have a Solvency I type of capital adequacy regime, this would not necessarily appear because these types of requirements are not risk sensitive. So you might capture it, but by accident, not by design. And in Solvency II, we try to capture these risks by design, up to a point, up to a level of confidence, I should say. So what we are asking our insurers in our market specifically to do is to follow the standard formula, obviously, of Solvency II, but then also to look at their own exposures and try to assess how much specific types of events would cost them, and then use that as a valuation for that part of the capital requirement. You can look at what the formula says in that big batch of documents that's called delegated regulations and so on and so on. You've got all sorts of factors there, and I don't want to go into that really, because A, we don't have enough time, and B, it's numbers, it's models, it's formulas, so look at that. You're very well equipped to read them and compute them and so on. So this is as far as I'll go in this respect. But I would like to show you some graphs and some let's say, maps that are the reason why we're doing that. One of them is this one, for example. So I took the numbers out of publicly available sources. Sources available to everybody, doesn't matter if you're a reinsurer now or not. This is publicly available. This is one of the reasons why we want to have natural disasters accounted for under Solvency II, because they do happen, and when they happen, they can be huge. For example, this spike here is 2011. There were quite a lot of different events there in that year. And blue line represents the economic costs of those disasters, cumulative economic costs. And the red line represents the insured losses, which means that A, there's room for improvement. So not everybody is insured. And B, these things can be really huge. And the next slide shows how huge. So this is exposure by events. For example, the worst one is Hurricane Katrina from 2005. That was the costliest catastrophe to the insurance industry recorded in the period from 1970 to 2017. And you will see, so the list is obvious. I mean, you've heard of these events. You've seen footage from those events. You've got various types of hurricanes. You've got earthquakes, like in Japan, for example, or Chile, floods, what's the word? Monsoon rains, damage to oil rigs, all sorts of things. So this basically, this type of information was one of the drivers for Solvency II for the introduction of these capital requirements in the Solvency II capital model, which is fine and well and proper and so on. But then, as you see from the list, the major events in the world happened elsewhere. They didn't happen in this particular region. And we, specifically my country, Slovenia, is a Solvency II type of country. So our local regulation is Solvency II compliant. So what do you do when the Solvency II formula is geared towards this? So first of all, you try to look at what the actual risks are. And again, this is publicly available information. I looked at the Copernicus project, which is a climate project of the European Union. So there you can see first the long time average of surface air temperature from the last 30 years and then compared with actual temperature by year. This is what's going on in the world right now. So this is the world graph, and below is the European graph, the graph of European deviations. One example is the weather that we're having today, for example. I remember last year, exactly 1 year ago, the temperature was probably about 30 degrees lower than today, probably. And would you say that is normal? Let's start with that. So this is one thing, and this is probably also one of the reasons why we have this. So that's one thing that you would look at. But then, if you look at the risks that appear in our region, they're not necessarily the same as those hurricanes and those the flood events that we saw on the previous picture. So I thought I would show you what happens in my home country in terms of extreme events, because there are quite a few of them. So the first one represents flood events in my country in the period between 2007 and 2014, where the important bits are the major floods, the red dots, and flash floods, violet dots. Very many of those have severely damaged the objects in their way. And this is from the flood risk assessment for Slovenia, which is again a publicly available document on the website of one of our ministries. So the actual exposure that we have is towards floods, but not necessarily in the same way as what we're looking for under the standard formula of Solvency II, to be very honest. And I would just like to show you what happens in my hometown, Ljubljana, the capital of Slovenia. So this is the map of Ljubljana overlaid with the flood risk map. So the blue areas are the normal, let's say, more or less normal frequent floodings that happened every year. This is a sort of a floodplain, and the light green ones are the catastrophic floods, and some of them have happened in, let's say, recent couple of decades. Not maybe to this extent, but at least some parts of Ljubljana were flooded. So, by the way, if you ever consider buying property in Ljubljana, you would be well advised to look at such maps. I, for example, have when I was buying my flat. So this is an event that will not be captured by Solvency II standard formula, but it will be experienced by the insurers in our region. So what do we do with that? That's one of the questions. And this is the map that signifies flood risk areas for Slovenia based on these maps that I've just shown you. Another risk that is valid for Slovenia, also valid for Macedonia, because our two countries lie on the same fault here along the Balkans, going all the way down to Turkey, through Turkey to Pakistan to India. That's the same fault line, and Italy as well. So, and you can see where the fault line goes through these colors. These colors represent in English it's called peak ground acceleration, and it's one of the indicators for earthquake risk. So let's say yellow areas, yellow and stronger colors, they would signify sort of earthquakes of the intensity between 6 and 7 on the European macroseismic scale. And the green ones would be less affected. But still, they would get some earthquakes, whereas in Ljubljana, you basically get daily earthquakes, just of a very small variety. So again, the question is, how do you deal with that? As an insurer and as a country as a whole, basically. So in terms of supervisory expectations, what we require our insurers to do is to phase that, actually. So first of all, they've got all those bits that are required under Solvency II, which is they need to take the formula as such, they need to value the risks, present them in form of all those reports that we're asking them for, and then we also ask them to produce an OSA. And deliberately, we did not want to prescribe the contents of the ORSA because we wanted them, the insurers, you, the actuaries, to think creatively about the risks that an individual company faces and then tell us about those risks. And I can tell you that our insurance companies weren't particularly happy with our choice because I suppose laying yourself bare in front of a regulator is never a nice thing because you imagine the worst things possible. So it's a very vulnerable thing to do. But if you are honest in that, honesty was mentioned a couple of times before in the presentation, so I'm not loath to use this word. So if you are prepared to do that, if you're honest in your risk exposures and tell us about that, we can do something with that. Let me see if this is already on the next slide. Yeah, it is. So and this is what we've tried to do with it. This is just a couple of sentences, but I will try to explain what our approach was. So, for example, our insurers were, without our direction, without our instructions, they were constantly across the board showing exposure to a couple of risks that were not captured well with the standard formula. So when we looked at that, and those are really unrelated insurers, so not members of the same group, or not even, let's say, Slovenian-owned insurers, but basically most of the insurers that operate in our market, they've shown us exposures to events like floods, we've just seen, hail events as well. So we took that information, we looked at it, and we said, okay, so if this happens across the board, and it's not captured in the standard formula, maybe that's a reason to engage with EIOPA on that. And that's exactly what we did. So there was an SCR review happening in the last couple of years. Immediately after Solvency II introduction, we've already started revising the formula, to be honest, or looking into possible revisions. So we used this data, plus some additional data that we then gathered from our actuaries in the market. We used that to go to EIOPA with that and say, look guys, we've got a market that is described through the standard formula like this, but the actual exposure is this. So we ask you to include this risk into the SCR review, even though it wasn't part of the original Commission's mandate, Commission being the European Commission. So we ask you to look into that from a broader perspective, and then hopefully we can find a solution that would better reflect our actual risks, because if we do that, then we would be more comfortable as a supervisor that the capital requirement represents the risks in our market, which needn't be the case if the formula was the way it was at the beginning. And they did that, and up to the extent that they could, they actually took that into account, which I thought was very positive. It needn't be the case. I mean, usually when you, and this might be a useful experience for you when you look from the outside into the EU and try to figure out how that works. Usually the assumption is that if you're a smaller country, there's no chance that you would get through with your ideas. And this shows that it's not true. You just have to have well-founded arguments and solid data, and just engage with the European structures, and then it's possible. So it needs a lot of activity from your side, but I suppose it's worth it. At least for us, it's worth it. So this is one thing that we did. And then, of course, obviously, we have other tasks that we do. So we always also look at the viability of the business model of an insurer. Because if the business model is not viable, you don't need a catastrophic risk to sink an insurer. It can be a smaller event, but it can impact a specific company in a major way. So we always look into that, and then we also perform stress tests and scenario tests. I will not go into that because that's too much detail, but if anybody's interested, I'm here, so you're free to contact me with any questions you might have. But I wanted to, just as a last slide, wanted to talk about another thing. So the maps that I showed you come out of national disaster risk assessments for Slovenia. And we have a role in that as well. It's a small role from our point of view, but it's a role nonetheless. So the government has adopted a Natural Disaster Recovery Act because there are events happening every year. Some of them are catastrophic in local terms, so there are a lot of people asking for state help. And I have to say, in our region specifically, at least that's my impression, in this region, we have that innate thought that it's the role of the state to take care of our problems, which sort of cancels out the need for insurance. So there is a moral hazard in our thinking, I think. So whenever there's a major event, let's say the farmers who have suffered, who have lost their crops, they don't think about preparing for that, let's say protecting the crops, changing the crops into something more viable. No, they go to the state and say, take care of us. So the Natural Disaster Recovery Act also takes care of those things, among others. And then it also provides for a national disaster risk assessments that can prepare the country as a whole for such events. Our role in that is to provide them with data on the insurance coverage, on the PMLs, reinsurance coverage, stuff like that, so that they know what the actual exposure is, so that they can plan for coverage of those, let's say, for the excess loss, to use a reinsurance term. So that's one thing. The other thing that we were also involved in recently, and I thought it would be interesting to point out, is the nuclear pool. So we've got a nuclear plant in Slovenia, and we've got a nuclear pool which has the same function as other nuclear pools in the world. So it's there to pool nuclear risks and take care of claims whenever an event occurs. But it covers these events only up to a certain point. And from there, at the moment, we're in the middle of discussions from an actuarial perspective, how to value those excess risks that are not covered in the pool, but would need to be covered in a special law or a special addendum to this Act on Liability for Nuclear Damage. Basically, the question is, what kind of premium should the nuclear plant pay to the state, and what should happen with that premium in order to cover for these types of risks? Very interesting questions on completely uninsurable risks. So, and I would also say that in terms of the EU, I would also categorize the currently very fashionable sustainable finance initiative as one of the governmental types of means to, or tools to deal with catastrophic risks in a way. I'm not sure, honestly, how successful that's going to be, but it's still in progress, so it remains to be seen what's going to happen in this field. And everybody else, or several of the speakers before, already mentioned the various catastrophe risk insurance facilities, so I wouldn't even go into that, to keep everything as short as possible. So I would stop here. I'm available for any questions now or later, either on our approach or maybe the governmental approach, but now I would leave the floor to everybody else. So thanks very much.